Can AI actually help you solve a McKinsey-style case? Let's test that properly. I'm going to use Cognidoor's McKinsey AI coach to work through a profitability case. I will treat it like a real case interview. I'll clarify the objective, build a structure, ask for data, read the exhibits, do the math, and land a recommendation. The goal is to see whether the coach can help me stay structured and learn how to case well while the case is unfolding. Before we start, we're going to use a case from Cognidoor's AI case library. The particular case that we'll use is a profitability case. You'll notice that once we start the case, you'll get 3 filters: beginner, intermediate, and advanced. All these filters were made to cater for the stage that you're at in your consulting interview prep. So if you're a beginner, this is a great filter to choose because here you'll get step-by-step coaching, which will take you through how to think about frameworks, mental math, and how to structure a good recommendation. So for the sake of this walkthrough, we're going to choose the beginner filter. Okay, before I begin, here's the setup. The main conversation is with the interviewer, which is the panel on the left, and that is where the case happens. While the coach panel on the right gives feedback while we answer. It can critique our previous responses and help us think about the current interviewer question. The scratch pad, which is at the bottom, and you open it like that, is where we keep our structure, our assumptions, our math, and our interim conclusions. And then the exhibits tab, which is right here, becomes available after the opening stage. If the interviewer refers us to data, we can open the tab and use the exhibits rather than waiting for a separate exhibit phase. All right, let's start our case. So our client is CloudDesk, a mid-market software as a service company selling workflow software to firms with 500 to 2,000 employees. The revenue has been flat, but profit has turned negative over the last 3 months. Management wants to know what is driving the decline and what CloudDesk should do over the next 2 quarters to restore profitability. These are the constraints. Number 1, no customer support layoffs. Number 2, engineering headcount changes should take more than 2 quarters. And number 3, the NPS score must stay at or above 40. So this is a profitability case with operating constraints. Our first job is to clarify the objective cleanly as we would in a real case interview. So we just need to confirm the goal, we need to confirm the constraints, and we need to confirm the objective. Great. Now that we've done that, we're going to wait for our interviewer to respond. And our interviewer has told us that our assumptions are correct. We're identifying the drivers of profit decline and defining actionable steps to restore profitability. And then the question that we're asked is how we'd like to approach this problem. And you'll notice that our coach on the right-hand side has taken us through our answer and told us what we did right. It's also given us a recommended response that to diagnose why profits have turned negative, we're going to use a profit bridge framework where we break it down into revenue and costs, which is exactly the kind of framework we want to use for a profitability case. When we scroll down here, we can see that it tells us our scratch pad is empty because we didn't fill anything out there, but it also reminds us what the objective is. It gives us formula for profit, for revenue, for costs, and it tells us the kind of angle that we should take as a map to guide our thinking as we go through the case. But back to our coach. But before we get to the framework, why don't we ask some clarifying questions? First, to understand what the last 3 months' performance have been. Second, to understand if we're optimizing for profit recovery or margin recovery. And third, if there's any actions that are explicitly off the table in addition to the constraints that we've been given. Great. Our interviewer has told us that that's a great start. And it gives us more detail. It tells us that we should compare the last 3 months against the immediate preceding quarter. And then it tells us that our listed constraints are the only ones off the table. And the question that it asks us is, what is the structure we'd like to use to approach the problem? Well, because this is a revenue versus cost problem, we'll look at revenue, where we check price, volume, mix, or retention. And on the cost side, we'll look at COGS, where we separate COGS from the operating expenses. And then we break COGS into the usage-based costs, fixed headcount costs, and any third-party tool costs. So our initial hypothesis is that the issue could be on the cost side, but we need more information. For that. But let's look at our coach. So our coach tells us that we need to present a clean profit bridge framework and that we should state that profit is revenue minus cost and explain why we'd like to look at both branches. But let's say, as beginners, we really don't know what to say. And so we're just going to tell our interviewer that and see how our coach reacts and advises us to go forward. Okay, so we've told our interviewer that. Now let's see what our coach says. So it tells us that focusing on cost is a logical starting point. However, to ensure our analysis is comprehensive, how would we structure our cost and revenue? So it's clearly asking us for a clear structure. And if we look at our coach, it gives us advice for what we're missing and what exactly we need to put here. And it talks about the McKinsey framework. And so in the recommended response, it tells us that profit is revenue minus costs. And revenue in this case, we'll look at price multiplied by volume, multiplied by mix, multiplied by customer segment. While cost is fixed costs and variable costs. So why don't we just copy and paste this answer and see what happens? Well, there we go. So our coach was right. This is a very good start. And our interview tells us that looking at the last 2 quarters, fixed costs like R&D and admin have remained flat, but variable costs have increased significantly. So it's asking us which specific variable cost categories would we like to examine first under this shift. Our coach tells us that we should translate variable costs into specific SaaS-driven hosting and infrastructure costs, customer support, and onboarding implementation costs, and then ask the interviewer which one of these is spiked. So why don't we give that answer? Great. So immediately notice that our coach is helping us understand that we need to go down a specific branch of our issue tree and continue to ask the right questions so we can get to the bottom of the problem. Our coach tells us that comparing this quarter to last, our company's hosting costs have increased by $700,000, while customer support costs have risen by $500,000, and onboarding costs have remained flat. So given these figures, where would we like to investigate first to understand why these costs have spiked? And if we look at our coach, it tells us that we should look at hosting costs because they represent the largest spike. And to understand this, we should look at the hosting costs as total hosting costs, where we look at volume, number of active customers, or data storage multiplied by the unit rate. And then we ask if we have more data because that's the only way that we can reach sensible conclusions. So let's just copy and paste that answer and see exactly where we go. Great. So our interviewer tells us that our data shows that while the total volume of data stored in our service has remained flat, the unit rate we pay has increased significantly in the North and South region. And the question we're asked is, what does this suggest about the underlying cause of this cost increase? This is very complicated. And once again, if we're stuck, we have our coach. We can help us understand exactly what we should be thinking. Our coach recommends that to answer it, we should use the following structure. It nudges us that an increase in regional unit rate with a flat overall volume suggests a regional change. So there's 2 possibilities. First, that there's been a shift in our mix of data storage towards a more expensive tier in both the North and the South. And second, that there may have been a contract change or a regional pricing change. So maybe we should explore this and check if the volume mix in regions has contributed to this or if our contracts in these regions could be the cause. So let's just copy paste that answer and see where we go. Here we go. So our interview tells us that it's going to help us narrow this down. It tells us that we've seen the total volume across the organization is flat, but the mix has shifted. North and South regions now account for a higher percentage of total volume compared to the previous quarter. Then the question is, what does this imply about the cost increase and what we should look at next? Right. So immediately, we need to investigate our profit bridge a little bit more so that we can identify what exactly is driving the decline. In this particular case, why don't we ask for more data, particularly around the costs? Great. So now we've asked our interviewer to give us the numbers. And here's what it tells us. For the past 2 quarters, our hosting costs in the North and South have grown by 25%, while the total data volume remained constant at 520 terabytes. So given that, what does that shift in unit cost tell us about the profit decline? And what would we like to look at next to confirm the issue? Well, it's very clear here that a 25% increase in regional unit costs decreases our profit margins, especially if our storage has remained the same. So we need to look at the exact volume split between North and South so that we can see if volume has shifted to more expensive areas, or so that we can see where exactly our expenses are coming from. Great. So our interviewer tells us that looking at expenses is a sound approach. Then it tells us to help us with understanding expenses. The North and South regions represent 22% and 17% of total data volume respectively, while the East region accounts for 11%. If our volume is flat overall, but is shifting towards these expensive regions, the question is, what does that mean for our margin expectations over the next 2 quarters? Now, our coach tells us that based on the data, North, South, and East regions make up together approximately about 50% of total volume. And because our volume is flat, but is shifting into higher cost areas where unit cost rose by 25%, What we really should expect is our average unit hosting cost to rise further in the future, which will definitely decrease our profit margins. Now, to estimate the exact margin impact, we need to calculate a weighted average cost increase, which is a really sensible approach. But to do this, we need to look at the unit cost difference. So this is where we're just asking for more data to clarify exactly what we're looking at. Great. So now we have more numbers. It tells us that the remaining 50% outside of the 3 regions we've been given currently has a unit cost that's remained stable at $1,000 per terabyte. For the North, South, and East regions, the unit costs have jumped to $1,333, $1,363, and $1,250 per terabyte, respectively. Given this spread, what does this tell us about the profit impact off this volume shift? Now, that's a very interesting question, considering the data we've been given. But remember that previously we said we're going to use a weighted average to try and understand what's going on? Well, the weighted average unit cost of this volume is roughly $1,325 or $1,325 per terabyte. And that's a very simple average calculation. This is where we need to start thinking about the kind of math that we put into this. But once we've done that calculation, we see that the $1,325 is a 32.5% increase over the $1,000 baseline that we've been given, which tells us that 50% of our volume is shifting towards regions where hosting costs could potentially be higher. So our coach is telling us that we need to calculate the exact dollar profit drop. Let's ask for the total volume in terabytes so we can see exactly where our profit is declining. Now, remember, as you do this, your coach is evaluating your answers and giving you tips if it thinks you're not going on the right track. At the end of the case, it's going to synthesize how we answered, how we did calculations, including what we put in our scratchpad to properly give us feedback on what to improve in the future. Now, our interviewer told us that we really did well in quantitative work, but to answer our question, the total data volume for the current quarter is exactly 520 terabytes. So what is the total dollar impact on hosting cost increases? So all we need to do here is do a simple calculation where we look at the absolute dollar increase in cost. And we're given the formula by our coach, including some of the numbers that we should use, which will be the $1,325 minus the baseline cost of $1,000. And that's it. That gives us a difference of 325 per terabyte. It's also important to put in your calculation here as you would do during a case interview. So why not tell the interviewer exactly how we're thinking and how we reached our conclusions? Right. So our calculations are correct. And our interviewer tells us this results in an $84,500 increase in those 3 regions. So the question is, given that the hosting cost issue only accounts for a portion of our overall profit decline, what other drivers could be responsible for this? And what else should we look at? So this is where we come back to a profit bridge framework to structure our next steps. And our coach here tells us exactly what we should be thinking. Since $84,500 hosting cost increase only explains a portion of the decline, we need to evaluate 2 key areas. On the cost side, our fixed costs, and second, on the revenue side, our software subscription volumes or any other price points that have changed. And we'll start by looking at the revenue side just to understand our subscription volumes over the last 3 months. So let's go ahead with that. Right. Our interviewer tells us that over the last 3 months, subscription volume has remained flat, but we've seen a $40,000 profit impact due to an increase in churn. What do we think this suggests about the relationship between our software performance and these consumer departures? Well, that gives us a really good insight into what might be going on here. If you're seeing high churn, maybe that's because our subscription rate has increased and we're actually not getting any more new subscriptions. Therefore, our profit is declining. So we're not getting in as much money, but our costs are remaining the same and in some cases increasing. So our coach tells us that one of the issues could be that we're failing to acquire new customers while losing existing ones, maybe due to poor performance of our servers or hosting issues in the regions where costs have increased. So using that hypothesis, we need to get some customer satisfaction data. So why don't we ask for that? So right here, we're getting help about the different pieces of the case that we should think about. And this is exactly what our coach is trained to do for the beginner filter. All right, now, the data shows a 15% increase in technical support tickets, specifically tied to latency issues in the North and South region over the same 3-month period, which already tells us that we need to improve our client strategy. So in the North and South region, where we've seen an increase in cost, we have performance issues, which shows us that there's a correlation between server latency, cost, and customer dissatisfaction. So to protect our profit margin, our immediate strategy should shift from customer acquisition to trying to fix the latency issues. We know that our costs, despite increasing, have remained relatively flat across all regions, which shows that the primary issue affecting us is that our service is no longer as reliable. So instead of trying to win over new customers, which we'll lose anyway, what we need to do is fix our existing problems so that we keep our current customer base, continue to receive recurring revenue, and then try to acquire new customers. That way, we can reduce further churn. And once we've done that, we should quantify the cost of resolving the technical issues, because maybe that's where we can figure out how to save on our margin decline. Right. So our interviewer tells us that that's a very sound recommendation. And it also tells us that because we've given that recommendation, we're nearing the close of our case. And that's how we conclude our case, because we've given a very strong recommendation. This is just a small example of how Cognidoor's AI coach is able to assist us with our answers, but also help us think about how to structure our thinking. Now that we're done with the case, we're going to view feedback from our coach. We wait for that to load and we look at our dashboard. So in our dashboard, we're able to see how far we are from being interview ready. And what we're told is that we're 75% away from being interview ready. We're able to see how many cases we've done, and we're able to see our performance across the different metrics that make a candidate successful, such as our structuring, our problem definition, as well as our synthesis and recommendation. And when we come and look at our coach feedback, we're told that we completed a case, our math was good, and we kept the case moving. But we're told that our recommendation needs to be more explicit and also needs to be measurable. And it tells us that what we need to think about next time is our objective, our hypothesis, and our McKinsey structure. And just to dwell on that a little bit more. That's the strength of Cognidoor's AI coach. It's able to understand the nuances of how to take a case. It's able to understand our answers and help us figure out exactly what to improve so that we're interview ready. Over time, you're able to track your performance. You're also able to save your coach feedback in your journal so that you can look at it for future use and understand exactly what you need to improve and also understand your improvement over time. So if you'd like a friendly, structured, and helpful case coach, why don't you visit Cognidoor and see how Cognidoor's interview-led and interviewee-led AI case coaches are able to help you get case interview ready. If you'd like to see tutorials like this and more about McKinsey or BCG and Bain case interview prep, stick around on our channel or visit Cognidoor.com and make use of one of our helpful case interview prep tools, because smart prep helps open doors. See you in the next one.